Welcome back to Carlton for Life. My name is Carlton, and I created this platform to educate people on how to use life insurance to build wealth. The best way to use life insurance to build wealth is to build your own bank. Now, in my last episode, we spoke about which type of life insurance company you should be using to build your own bank. And after watching that episode, there should be no doubt that a mutual life insurance company is what you should use, not a stock life insurance company. Today, we're going to talk about what type of life insurance policy you should be using to build your own bank. And after today's episode, there should be no doubt that you should be using a participating whole life insurance policy with a paid up additions rider. Let's get into it. Listen, when it comes to the infinite banking concept or building your own bank, you will hear so many different opinions as to which type of life insurance policy you should be using to build your own bank. I advise my clients to only use a whole life insurance policy. There are many reasons why, and that's what we're going to talk about today. Now, before we talk about why we should be using a whole life insurance policy, let's make sure we understand what a whole life insurance policy is. Because sometimes when I review people's policies, they have all kind of different policies and don't even realize what they have in front of them is actually not a whole life insurance policy. So, what is a whole life insurance policy? It's a specific type of permanent life insurance. And I think the confusion comes in when we talk about life insurance in general. We usually give you two options, right? We say, do you want a term policy or a whole life policy? And really, what we're saying is, do you want a temporary policy or a permanent policy, right? The temporary is the term, the permanent is the whole life. And that's why some people may believe because they have a permanent policy that automatically means they have a whole life policy. That's not actually true. You have different types of permanent policies, right? Universal life is a type of permanent policy. You have index universal life, you have variable universal life, and you have universal life. These are permanent policies, but they're not whole life insurance. Now, what's the difference? The difference, I would say, mainly is in the guarantees, right? The flexibility. Whole life insurance is less flexible, but it has more guarantees. And that's why I like to use whole life insurance instead of universal life insurance policies for banking. Now, I'm going to do a whole nother video on why I believe you shouldn't use any type of universal life policy. Today, let's stick to why we're using whole life insurance. And there's three main reasons: simplicity, consistency, predictability, right? For these three reasons, I think whole life insurance is best for building a bank. Let's talk about them. Simplicity. It's like the saying KISS, keep it simple, stupid. I'm building a bank here. I'm trying to accomplish something. I don't need it to be complex. I don't need to complicate things. With a whole life insurance policy, I get my premium up front. I know what it's going to be. I pay it every month. I know my death benefit is going to be there no matter what. I can look at the illustration and understand it. It's not complex. And I can focus on other things while I'm building my own bank. Consistency. I know that as long as I'm paying my policy every single month, it will consistently grow. There are not too many variables in the way to throw me off, right? I know what's going on in my policy. And lastly, predictability. When you're looking at a whole life insurance policy illustration, you're looking at numbers, right? So when you get to the point of the illustration where it's showing you how your numbers grow every time, there's two different columns. You have a guaranteed column and you have a not guaranteed column. Now, what's on the guaranteed column? In the guaranteed column, they're basically saying these are the numbers that your cash value will grow over the years no matter what. This is constant, right? This will not change. And the reason why they know what these numbers are and they can guarantee these numbers is because a whole life insurance policy guarantees you a certain rate of return. For instance, in your contract, when you get your policy, it'll say something like the guaranteed rate of return is 4%. And what that means is we will pay you, the company's going to pay you 4% on your cash value no matter what. That's the numbers you see in the guaranteed column. Now, the not guaranteed column, non guaranteed, that's going to be if a dividend is paid. If the current dividend, that whatever they declared when that illustration was made, is paid every single year, then that's what the illustration shows in the non guaranteed column. So when we talk about predictability, what we want to think about is, can we actually predict this column to be what it says it's going to be. And all that has to happen there is the dividend has to be paid every year. And we can kind of assume or predict that that is what's possible. Now, how often do these mutual companies pay a dividend? There are mutual companies that have paid a dividend for 150 years straight. And I mean that literally. For the last 150 years, these mutual companies, some of them, have paid a dividend without missing a year. They've paid a dividend through the Great Depression, World War One, World War Two, during the housing crisis, even during COVID. They've always paid a dividend. It's important to understand the dividend is not guaranteed, but when it comes to looking at an illustration and trying to understand what's possible, we can look at these numbers and we can say, hey, I know what's guaranteed. And if a dividend continues to be paid over the next 30, 40 years as it's been being paid, then I can look at the non guaranteed side and say, hey, maybe I'll get that. That's super simple. It's super consistent. It's super predictable. That's why I like to use a whole life insurance policy, right? Other type of policies, there are so many more variables, it just gets confusing. And when I'm building my bank, I want guarantees. I want to know what's possible. I want to know how my cash value is going to grow. And I don't need anything to happen that I can't predict or that makes it harder for me to predict. Now, for these numbers to grow the way I want them to grow, you need to have a participating policy. That's a dividend paying policy. And if you got a company, like I said, a mutual company, when you got your policy, all you have to do is make sure that the whole life insurance policy you have is participating, which means it does participate in dividends. Now, you also need to make sure your whole life insurance policy has what's called a PUA rider. What's that? It's a rider to the policy. Riders are like extra features that you add onto your life insurance policy. This PUA, paid up additions rider, allows you to overfund your policy. One of the biggest complaints that I get when people don't really understand how building your own bank or the infinite banking concept works, they come to me and say, hey, I got a whole life policy. I've had it for years, but the money grows really slow. What's the benefit in building my own bank if I'm going to have a policy for 10, 15 years and I got about $3,000, $4,000 in there? That's not really doing anything for me. And I understand where they're coming from. And that's where this PUA rider comes in. It allows you to overfund your policy. Every dollar over the cost of your premium payment that you put into your policy goes straight to your cash value. It grows your cash value faster, and that guaranteed rate the life insurance company said they're going to give you gets paid on that cash value. That dividend that's not guaranteed but has been paid every year for the last 100 years, it gets paid on that cash value. So you want to put extra money in there to grow your cash value faster. Without putting that extra money in there, it's going to take a few years just to get any cash value in there, right? But when you overfund your policy, within the first year, your cash value will start growing. And as you look at an illustration, you have your agent make an illustration for you, and they can show you how much faster it will grow over time when you put more money in there. Now, let's say you don't have a lot of money to start out, right? Let's say you just got your policy. It's $150 a month, and right now you really can't afford much more. You'd like to, but you can't afford much more. You just make sure you get the paid up additions rider, right? And to get the rider, you just have to put a certain amount of money in the policy extra every single month. So let's say you say, you know what? For right now, I just got the policy. I'm going to put an extra $30 a month in there, right? So you just get the rider, you put that extra 30 to make sure you have the ability to overfund your policy. And as time goes on, maybe you start making more money, maybe you figure out ways to get more money. Now you can start putting even more in there. So although you started out with a little extra $30 a month, you can put even more. And the idea is to overfund this policy, build this cash value up, take your time. I get a lot of questions. One of the biggest questions I get about building your own bank is, how soon can I start borrowing the money? How soon from when I put the money can I access it? The minute I get the policy, can I access the money? It depends on how your cash value looks. If you have a couple $1,000s sitting around and you want to pour that thousand into the policy the minute you get the policy, then yes, you'll be able to borrow it right back out with some companies, right? Some companies want you to wait a year. Some companies, as long as you have cash value in there, you can borrow it. Companies are different. So you have to figure out which one fits your needs, right? But the idea of this building your own bank is to let it build. You have to let your cash value build. This is not a get rich quick scheme. This is something that's going to take time. You need to build your bank over time. Now, if you have thousands of dollars sitting around and you'd like to pour it into your policy, Yes, you can do that. You can design the policy in a way where right away you'll have a few thousand of 10, 20,000 in there to do things you want to do. But if you're just starting out and you're going to be making monthly payments, you have to pay these policies over the months, over the years. Let the cash value build up. This is a great opportunity to start educating yourself on real estate investing, options and stock market investing. I mean, there's so many things you can do while you're building your bank. So by the time your cash value gets a significant amount in there and you're ready to borrow it, you can make some great financial moves and you'll be educated on this stuff. So, yes, this is a slow motion move. This isn't something that's going to, boom, I'm going to be wealthy because I'm starting to build my own bank. You take your time, you financially educate yourself, and you make sure you have the right type of policy. So let's recap. What kind of policy do you want? You want a whole life insurance policy that participates in dividends with a PUA, a paid up additions rider. That's what you want. Why do you want that? Three reasons: simplicity, consistency, predictability. You don't need a complex product. You don't need something that you don't fully understand. A wise man once said the best way to lose money is to not understand where you have it at, right? Don't complicate this. Make it simple. Get a simple product. Make sure it's consistent and predictable. Understand how much it's possible to have, and then educate yourself on financial strategies that you'll be able to use when that money gets where you want it to get. Like, share, subscribe, and let's continue to learn how to build this bank.